Hi guys, this is Mrs. Kyle. This is how we're going to run most of the class. We'll do the working togethers on the smartboard, and you can watch it, and then you'll have to do the on your own. So first thing first, this first chapter is really a review from last year's accounting. So if you turn to page 11 in the book, then we're going to do chapter 1.1, work together. Just a review, if you don't have the textbook in front of you, you can click on this blue link and the instructions will come up for you if you need it. I've also attached a couple documents on Moodle. There's the source documents for journals that will help you out. So you know that C's go in cash payments journals, P goes in purchases journal, and so on. So that's there to help you. And I also attached the accounting equation. Remember that debit is always the left side and a credit is always the right side. Your normal balance side is the sign that increases. All right, so we're going to start this problem together. The directions say, write the answers to the following problems in the working papers. Your instructor will guide you through the following examples. Number 1, prepare a T account for each account. Enter the title of account. Well, that's already been done for us, so we don't have to worry about that. In parentheses to the right of the account title, identify the account as an asset, liability, owner's equity, revenue, or an expense. And again, if you go to Moodle and you open up, you scroll down under chapter 1 and you open up the accounting equation. This will help you out a little bit as well. All right, so let's get back to Aplia. So prepaid insurance is an asset account. It's something of value. Label the sides debit and credit sides. Well, we know that debit is always your left side and credit is always your right side. Regardless of it goes up or down, debit's always the left, credit's always the right. Label each side of the T account using labels normal balance, increase side, or decrease side. Well, prepaid insurance is an asset. So looking back at we open assets, any asset, your increase side is always your debit, your decrease is always your credit. So your normal balance then is always the side that increases. So in this case, it will be a debit. So let's see. Increase side, decrease side, and normal balance. All right, so that will be true for all assets. So we going over here, we'll go this way, merchandise inventory. So inventory is the products that you sell. So again, it's something of value, so it's going to be an asset. And all assets will be set up the same. So we got a debit. Your right side's always the credit side, your normal balance, increase side, decrease side. Okay? Advertising expense. So an expense is going to be an expense. And an expense, we got, debit, credit. Expenses, when they go up, it is always going to be a debit. All right. Oh, excuse me. Increase side, decrease side. Okay, moving on to an accounts receivable account. And in the textbook, in parentheses, they'll tell you that Nugent Entertainment is an accounts receivable. So an accounts receivable is going to be an asset. Again, always we got the debit being the left, the credit being the right. So with an asset, your normal balance side is your debit. So your increase side is your debit. Your decrease side is a credit. Again, all your assets, prepaid insurance, merchandise inventory, accounts receivable, will always be the same. Lee Enterprises. So Lee Enterprises is an accounts payable. So anything that ends in the word payable is a liability. So this one's going to be a bit different. We always have a debit being the left, credit being a right. So now, looking at our sheet here, a liability, your increase side is always your credit side, and a debit is always your decrease side. So it's opposite of assets because it's on the opposite side of the equal sign in the accounting equation. So our debit is our decrease side, our credit is our increase side. So then our normal balance, which is the side that increases, is going to be a credit. Sales is going to be a revenue account. This is how we're going to make money. So sales is going to be, again, your left side is a debit, your right side is a credit. However, we know that we're never going to have a decrease of sales because that would be sales, returns, and allowances. However, they still want us to put it there. So our normal balance side is our credit, and our increase side is our credit as well. Again, looking at this, there's an X in there because you're never going to have a debit your sales. Actually, I shouldn't say never. You will when you do your closing entries when you're trying to get to zero out, but not when you journalize. All right, so capital stock is going to be our owner's equity. Because we have shareholders, we are a corporation. All right, so we sell stock, and that's how we get ownership in the company. So debit, credit, never going to change. So capital stock, your debit side is going to be your decrease. Your normal balance will be your credit, and your increase side. Again, looking at this, even though we have owner's equity, which would be capital if it was a sole proprietorship or a partnership, in this case, it's going to be capital stock because it's a corporation. Cash is an asset. We always have debit, credit. So our normal balance for asset is your debit side, increase, and decrease. All right. So I'm going to have this as practice for you right now. So once you're done, I want you to hit check answer. And we got 100. So then I'm going to have you save and continue. And you're going to do 1-1 on your own, which will be graded. If you have any questions, make sure to put it in Moodle or put it to the forms, and I will be back to you, or one of your classmates can help you out. Thanks so much, and I hope you have a great day.